Welcome to the Killik and Co podcast for June the 2nd. A quick glance back at last week. Well, it was quite dry. It was a half-term week and market volume and volatility was both pretty much at record lows, as we'll demonstrate in the charts. Will it be the same this week? Well, certainly it's set up for more action. We have really the key interest is around Thursday, where the ECB have given quite a green light in previous comments to some policy action at the time of their interest rates, and we'll take a look at some of the charts leading into that particular decision. So without further ado, let's just take a look at some of the sort of key charts for this week. First of all, a diary of the week ahead. What you will note is that the corporate reporting season has dried up a little bit now. We have got some results due from Tesco's. They'll be updating the market on trading, but it really goes back to the macros. We've already seen this morning on Monday the European PMIs a little bit softer, and in fact as a result the euro is continuing that recent weakness that we've seen over the course of the last month. We also turn tomorrow to eurozone CPI estimates. This is the inflation indication for the eurozone. Now, this is pretty much a key setup for the decision on Thursday, and that number is expected to come through at 0.7% on the inflation. Of course, most of the major economies around the world do tend to target 2% as the optimum number, and the eurozone has been running way below that for some considerable time now. And the suspicion is that they'll be projecting that it will continue to remain sub 2% at least through until the mid part of 2016. One of the reasons why we suspect that they will be taking action at this meeting. It is also for the UK MPC committee. It's going to be less activity around the MPC decision, and indeed no statement will be attached, so we won't learn as to who has voted for an unchanged policy on Bank of England action. But the market was woken up to an FT statement or an FT story last week with Martin Will, one of the outsider MPC committee members, who had indicated a call to action earlier and a more gradual rate of increase on interest rates rather than leaving it too late. So there is a suspicion that there may be just a little bit more of a split vote this time around, but we won't learn about that this week, only when the statement is published in the next week or two. And on Friday we have the US non-farm payroll data. This data has been strong over the course of the last 3 to 4 months. We've been printing numbers of in excess of 200,000 jobs, new jobs being created, albeit that the unemployment rate is anticipated to rise a touch this month as the labour force is expected to have grown slightly larger than that number has indicated. So let's turn to some of the charts, and going back to the euro. And really this is the comment that happened about a month ago, where the euro was just about to touch 140 against the US dollar, but it was the indication in the Q&A session with President Draghi, where they were set up nicely for some action in June that has led to some concerted weakness in the euro since that period of time. So the market is pricing in some activity around that particular decision. The thinking is that there will be cuts to the 3 interest rates, including potentially a negative deposit rate, which will be a case for trying to stimulate banks in terms of charging them for holding cash, encouraging them to be spending and lending to smaller businesses. And it's that activity which is leading to some of the more hawkish members of that committee possibly voting for that type of programme to be announced on Thursday of this week. So it'd be fair to say that there is room for disappointment as the market is set up for plenty of activity from the ECB on Thursday. Just turning somewhat to the US 10-year yields, and this really picture has been extended right through the sort of the bond markets. It is the strengthening of the bond markets that has been the key story over the course of the last 3 or 4 weeks. And as a result of that, the yield that you can achieve off of 10-year paper, whether it be for the US, the UK or through most of Europe, has been in decline, as this chart has been indicating. So we are printing 2014 lows on the yields. Indeed, it now is over a sort of 1-year period. These yields last seen around June of 2013. It did actually touch around 240, just bounced off there, but you can see that strength in treasuries at the moment. And a lot of head scratching continues to take place as to what is this telling us at the moment. And particularly, as I say, we've got this sort of mixed message coming out here in the UK of rates going up, the ECB where rates are going down, and the US where they're printing some GDP numbers, particularly for the first quarter, that still remain sort of well under trend for that at the moment, despite the growth in the unemployment market. So this strength in Treasury, it's certainly beginning to assist some of the big hedge funds that have been very much exposed to the Treasury markets. So they were posting some good gains during the course of May, and that's been some time coming. Turning to some of the other charts of interest last week, iron ore prices hit some lows, certainly lows that we haven't seen for 18 months. Iron ore is a big driver of Rio Tinto shares. That's a big commodity for them, and Rio Tinto shares were also printing lows around the sort of 2014 lows. So whilst the FTSE 100 has been sort of moving higher and taking out sort of record high territory, as indicated by this chart, it's doing so without the support of the mining sector, which, as I mentioned, printing the sort of lows of 2014. If they had a bit more support out of the mining sector, we would certainly be printing 7,000 at the moment. So that's going to be a key sector for the turnaround. FTSE is being supported by takeover activity, and again we had a surge of interest around Smith and Nephew. This is the £8 billion company that supplies hips and joints, and the business had a US rival, Stryker, confirming that they're not going to be making a bid at this stage. But despite that, the shares really continue to sort of push on to all-time highs. At the moment, the feeling is that it's quite a small, close community of companies that tend to dominate this high growth end of the market. And if one doesn't go for them, well, is the company in play? Certainly Stryker gave themselves an option that should one of their near rivals bid for Smith & Nephew, they have the full sort of flexibility to come in and join the bidding war. So Smith & Nephew, as a result, hasn't lost some of that bid premium that it gained on the back of that news. Mentioned Tesco, the trading update. It has been woeful for Tesco, and again it's another sector that is underperforming. But we've seen a little bit of rebound back above the £3 level, and again the indication over the weekend is that this is going to be a poor trading update from Tesco's. The market continuing to find some severe headwinds at the moment from the lack of consumer spending growth and the growth in online. You may recall last week we initiated a buy note on Ocado. Those shares actually did move very significantly last week, up around 14%. And it's quite interesting to see the diverging trends between the online community, which still only represents about 3% of the spend in food convenience, compared to Tesco at the moment. So there was a strong move on that side. And really just finally wanted to comment on volatility. We mentioned last week we were printing new lows, and this is the chart that is demonstrating that, printing down at 11.4 on the VIX. This is a measure of S&P 500 volatility. You can look at other measures, but it's indicative of the moment of the lack of movement in markets at the moment, often aligned with a feeling of general complacency around. The question mark is, are we being fooled by this lack of complacency, or this plenty of complacency at the moment, and will that VIX suddenly have a spike higher? It's certainly the case that option prices are much lower when the VIX is low. Volatility is a component of option pricing, and so if anybody is looking to take a bit of insurance cover against these stock markets at the moment, it may be worth having a look at the premiums to pay for puts at this stage.